Debt Lesson 7, Payday Loans.
In this lesson, you're going to learn about what payday loans are, why they're so bad to use, what happens when you can't pay them back, and how people get trapped in their vicious cycle of debt. Payday loans are short-term loans that on average range from $300 to $1,000 depending on your state laws, and the money can be given to you in cash or deposited into your bank account within 2 business days. Full repayment for these payday loans are supposed to be within 2 weeks. These type of loans are extremely predatory and target people who tend to struggle the most financially. Payday loan companies can be called a different number of things. For example, payday loans can also be known as cash advance loans, deferred deposit loans, check advance loans, post-dated check loans, and credit access. Whatever it is that they're called, they typically work the same way. So who uses these predatory loans? They target people who are strapped for cash, which are typically lower income families earning $30,000 a year or less, who are in a bad spot. These people typically can't qualify for a credit card and oftentimes look at payday loans as the only solution to whatever emergency they're experiencing. When it comes to payday loans, it doesn't matter if you have bad credit or no credit at all. Payday loan centers just want to verify that you're 18 or older, you've got a job, and a bank account. They already know that you're in a bad spot because people who resort to using payday loans are typically pretty desperate. Payday lenders can mask the true interest rates for what they charge. For example, a lender could tell you that the interest rate is 25%, but what they don't tell you is that that 25% is charged monthly, not annually, which means that the yearly interest rate is actually 300% over 12 months. 80% of the people who borrow money from payday loan centers can't repay their loan within the original 2 weeks that they were supposed to repay it. It is estimated that roughly 12 million Americans use payday loans each year, and payday loan companies bring in $9 billion in just loan fees. That's roughly $750 per person that borrows money from them. When it comes time to paying back what you owe, payday lenders typically have 2 options. Option 1 is to post-date a check for the next time that you get paid. Post-dating a check is when you write a future date on the check instead of the date that you're actually writing the check. And then they cash that check on that future date, which is typically your next payday. The other option is that you authorize them to debit your account on the day that you get paid. The amount that you agreed to repay is the full amount of money borrowed plus any interest and fees that were added. So what happens if you're like the 80% of people who borrow money and can't afford to pay back the loan on time? Well, to start, lenders are going to try to withdraw the money from your account or cash the check the day it's due. If you don't have the money and the payment doesn't go through, the lender will sometimes keep attempting to withdraw smaller amounts of money until the payment goes through. If your bank account goes negative, your bank is going to charge you an overdraft fee on top of everything else. You may be able to get them to extend that due date, but typically people end up reborrowing money from the lender to pay back the lender, which sounds completely crazy, but it happens. According to the Consumer Financial Protection Bureau, first-time payday loans are typically reborrowed 9 times or more. What happens with these loans is that people end up in a vicious cycle of debt. They borrow money because they're in a bad spot and they're desperate. Then they use that money to cover whatever emergency there was. They're already typically living paycheck to paycheck and they don't have anything left over at the end of the month. So when it comes time to repay this payday loan, they can't afford to. So what do? They borrow the money again to cover the previous loan. Like I had said earlier, this happens on average 9 times. Meanwhile, the interest rate is exploding in growth, making it harder and harder to pay off the amount that you owed, and this is the horrible cycle of debt which gets out of hand, which is why we never recommend payday loans as an option ever. Different states have different laws around these types of loans. In fact, they're so bad that 13 states have actually banned them. Currently, the average interest rate for a payday loan is 391%, and some states even allow lenders to charge up to 750%. Thankfully, a few states have started setting interest rate caps at 36%, and the trend seems to be catching on with more and more states approving interest rate caps. Some states have rules on the amount of money payday loan centers can charge for fees, while some ban additional fees altogether. But on average, the fees can range from anywhere from $10 to $30 for every $100 borrowed. So if you borrow $500, you can be charged anywhere from $50 to $150 on top of that $500. That applies every time that you reborrow money to pay off the amount of money that you already couldn't pay back, and it's completely separate from interest. You can find online calculators for virtually anything. For car loans, mortgages, credit card balances, if you want to know how much it is to pay something off, there's going to be an overwhelming amount of calculators online, but not for payday loans. It's so hard to find a free calculator online, which makes it that much harder to figure out how much money that you'd owe if you made the mistake of using one of these predatory loans. My mom used payday loans a lot when I was a kid, and it ended badly. She wasn't able to pay back the loan in full, plus all of the fees. So what did she do? She got more payday loans. It spiraled into a never-ending cycle of debt where my mom owed a lot of money that she couldn't pay back. In fact, I'm pretty sure that she still owes money to some of those places today. Payday loans sound like a lifesaver if you're in need of quick cash, but with the high fees and short repayment terms can lead to a cycle of debt that's hard to recover from. I watched it happen to my mom, and although I don't know you, I don't want it to happen to you. In the end, payday loans can make your financial situation a lot worse. Sometimes missing the payment on the bill that you can't afford is the lesser of two evils. If you're looking to get a payday loan to cover your bill that you owe, a better option is to call to whoever you owe money to and let them know what's going on. Most companies will give you a grace period and let you pay your bill late. Sometimes they might even work out a payment plan with you. Obviously, you don't want to make a habit of doing this, but sometimes the solution can just be a phone call away. The main point that we want to get across is that you should do whatever it takes necessary to stay away from payday loans. You just learned what payday loans are, what makes them predatory, why they're so hard to pay back, and how vicious the cycle of debt can be if you use these types of loans. In the next lesson, you'll learn about different types of court-issued debts.